Hello, in this presentation we will record an advanced customer payment in our bookkeeping problem in Excel, always keeping in mind how that same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to first take a quick look at QuickBooks and then jump over to Excel and enter this information. We're entering an advanced customer payment, meaning we got paid from a customer before we did the work. We've seen this before in the past, so I'm going to go a little bit faster this time. If you want more detail, take a look at the prior presentation. We're here in the flowchart for the customers. We see in the flowchart that the typical process would be that we would create an invoice, typically at the time that we do the work. In our case, if we sell guitars at the time we deliver the guitar, that's when we completed the job. And then we would expect to receive payment in the mail. When we do, we would record that payment. We here are going to be doing the reverse item, meaning we're going to record the payment before we create the invoice. Doesn't happen all the time, happens in particular industries more than other types of industries. For example, if we were to sell subscriptions of some type like newspapers, then this is going to be the typical process. But most businesses either get paid after they do the work or at the same time, which means they would be using create invoice or create sales receipt before they would receive a payment. But in this case, we're saying in our case, we might be getting a security deposit on a particular guitar. If we don't have a guitar in stock, we might say, hey, give us a security deposit. We'll hold on to it for you. And then if you come back and pay for the rest of it, we'll give you the guitar. So that might be the process that is happening here. We already got a partial payment. We're holding on to the guitar. When they get back and finish the job or finish the payment, we'll give them the guitar. Then we can recognize revenue and record the revenue at that point in time. When we record this, it's a little unusual because we will be increasing cash, undeposited funds, by the receipt of payment. The other side in traditional, generally accepted accounting principles would go to the undeposited, it would go to, not to undeposited funds, the other side of it would go to unearned revenue, a liability account. Here, we're going to put it to a negative receivable. We're in essence reducing the receivable even though we don't have the related invoice to it. That's the unusual piece. Let's see what it looks like in QuickBooks, and then we'll jump over and analyze why that would happen in Excel. The section will look much the same when we record the receipt of payment. We're going to have the customer, we're going to have the amount of the receipt payment, the date, but there's no invoice down here. There's no invoice to tie it out to. So we're getting a payment, not able to tie it out to any invoice. That's the unusual piece, a piece that will cause a negative receivable. So we will have this customer string guitars and we'll have a negative receivable there for that particular customer. And later when we tie out the invoice, it'll be okay. But at that point in time, it looks funny because an accounts receivable is not supposed to be negative. We shouldn't have in the receivable the fact that we owe a customer money. It should be the fact that we have a liability, unearned revenue of some kind, representing the fact that we owe money. That's what liabilities are. Receivables, assets aren't that. They aren't us owing money. But it works out and it makes sense because we're able then to track this customer payment and the invoice within the same register. So it makes logistic sense, not quite generally accepted accounting principles. If there is a problem at the end of the month, we'll adjust it. We'll talk more about that later, but let's enter this into Excel. So we got an advanced customer payment. We're going to record the journal entry. We're going to go through our normal process, which is first question, is cash affected? It is, not the checking account though. It's going to go into undeposited funds, this other type of a cash account where we're going to hold the cash until we go to the bank and deposit it into the checking account. So we're going to copy the undeposited funds. We will debit it, increasing that account. Right click and copy. Scrolling down, we're going to have the new date down here in F26, date of 2/21. We're going to paste the debit in G26, right clicking and pasting 1, 2, 3. Amount will be 300, the amount we received from a customer as a deposit and advance payment on a guitar. We hope to sell them in the future. We're then going to credit something for that $300. We're not going to credit sales because we didn't make the sale yet, so we can't credit sales. We haven't earned this money yet. We don't earn it until we deliver or give the guitar. We would credit typically unearned revenue in normal generally accepted accounting principles, but we don't want to put it there in terms of tracking it. It's going to be more difficult for us to track in a subsidiary ledger if we do that. So what we're going to do is create a negative receivable. It's not going to make our receivable here go negative, but we'll see that it's a negative receivable when we look at the subsidiary accounts as we post them to the subsidiary accounts shortly. So we're going to copy this. This is going to be the other side, accounts receivable, copying the receivable. And we're going to put that in G27, right click and paste 1, 2, 3. We're then going to go to the Home tab. We're going to go to the alignment group and increase the indentation. Here is our journal entry. It looks like a journal entry that we would have when we receive money on account, when we get paid for something that we invoiced in the past, except we didn't invoice something in the past this time. That's what makes it funny. We've got this reduction to accounts receivable before we had the increase to accounts receivable. That's what's funny. That's what's not exactly generally accepted accounting principles. Let's post this out and then take a look at the subsidiary ledger. Then we'll talk more about that. So first we're going to post the undeposited funds right here. It's going to be, what is that, 1, 2, 3, 4, 5, the 6th account on the trial balance, and therefore the 6th account on the general ledger. Scrolling over to the 6th account on the general ledger. Oh, let's freeze the panes first. I'm going to scroll all the way back. Freezing the panes will lessen the pain of posting. So we're going to go up to the top in AJ1. We're going to go to the View tab, Windows group, and freeze panes, and then we'll freeze the panes. And that will surely lessen the pain of posting. Now we're going to go over to the 6th account on the general ledger, the undeposited funds account. Scrolling over to the 6th account in the general ledger, scrolling down to the 6th account in the general ledger, there it is, undeposited funds. We are in cell AU25. AU25. We're going to put that 300 in AU25 by saying equals, pointing to the 300, bringing the balance of 250 up by 300 to 550. Same 550 should then be on the trial balance. Let's check that out, see if it is. And there it is, 550. We're out of balance by 300, the other side of this transaction. There's the other side, it's in accounts receivable. That, if we look at the trial balance, is the 2nd account on the trial balance, and therefore will be the 2nd account on the general ledger, which we will find now. Scrolling over to the 2nd account on the general ledger, there it is, accounts receivable. We want to be in AQ12. AQ12, scrolling down, we want to pick up that 300. We're going to have to scroll down just a bit, so what we're going to do is say equals, scroll down a bit, and pick up that 300. Let's do that now. We're in AQ12, equals, scrolling down just a bit, picking up that 300, and enter. Brings the balance to 2,240. If we, oh, wait a sec, we put that on the debit side. It should be on the credit side. Note the balance is correct, but to be, perfectly correct, this should be on the other side. So I'm going to delete that and redo that to make it look right. So we're on the credit side. We're actually on AR12. And what we're going to do is be on AR12, select enter, scroll down just a bit, and pick up that 300. Let's do that now. Equals, scroll down just a bit, pick up that 300, and enter. So we are still at 2,240, but that is in the proper place now. And if we scroll to the left, we should see that 2,240 on the trial balance. Here in accounts receivable, the 2nd account, there it is, 2,240. We have now recorded, journalized the journal entry in the general ledger and posted it to the general journal, but we still need to look at this accounts receivable in the subsidiary ledger and post that there. And that's when we're really going to see kind of the difference of what would happen under generally accepted accounting principles and what we are doing here. And we'll go over why and the pros and cons. So let's scroll over to the subsidiary ledger. I'm just scrolling right, and it's a nice scroll to the right, and there they are. It's in the columns CR through CX. They're right there. And then we're going to scroll down, and we're looking for string music. Let's see, is that a new customer? I think that's a new customer. Let's set that up. String music has magically appeared now. We just set that up for you. It'll be on your worksheet, so we're going to be in string music. Funny thing is that string music doesn't owe us any money considering they're a new customer, and we're going to put a credit to it. So we're going to basically say that String Music, we owe them money. Why? Because they gave us money and we didn't give them anything. We owe them the $300 back, or we owe them what we promised them, which I would assume is a guitar in this case, as the partial payment or the payment for this, and then they're going to owe us more money when we give them the guitar most likely. So we're going to say this equals the $300. So we have that negative receivable. This is really a liability. There's no such thing as a receivable, an account receivable. That means people owe us money. It doesn't mean we owe someone else money. But the convenience of this is that it tracks it right in the same area as our other customers, and when we do get the invoice, we can match it up here. It'll be a bit out of order, but it works great logistically. It's not generally accepted accounting principles because it's lowering our accounts receivable, but if this gets to the end of the month and we still have this balance outstanding, we will make an adjusting entry for it and then reverse it. Doing a reversing entry, we'll talk more about how we can do that at the end. So those are kind of the pros and cons. It's not exactly right, but logistically it works, and we can set up a system so that we can adjust these in the adjusting entries and make it all work out as long as we know what is going on and why it is going on and how to account for it. So this is going to be the balance, and that's the balance of all the people that owe us money, the total accounts receivable. That 2,240 should also be found on the trial balance. Let's check that out, see if it is. We're going to click right on the left-hand side of the freezed panes, go to the right, and it should bounce over there. There's the 2,240. It looks like it ties out. That looks good. Let's just go check our financial statements and see what has been updated over there automatically. We are first going to unfreeze the panes, so we're going to go to the View tab, Windows Group, Freeze Panes, and we no longer need the frozen panes to reduce the pain of posting. Then we're going to say that we did something to the receivables, so I'm going to say that there's the receivable. We're just going to point to it on the financials. We also did something to undeposited funds. So I'm just going to point to that, check the financials, see what happened over there, make sure we're still in balance. Go for a nice scroll to the right. We're going to a scroll to the right to the financial statements that are in the columns BW to CC. And we see that the accounts receivable has been updated. That looks good. Unearned undeposited funds, 550. That looks good, although it should probably be part of cash, but we're going to break it out so we can check it out. And then we have the total assets, which also still equal the total liabilities and equity. That's good. Then we're going to look at the income statement. No effect on the income statement from this transaction, even though we got cash. Why? Because we didn't earn it. We haven't earned it. And how do we earn it? We give the guitar, haven't done it. Revenue recognition principle, not letting us record revenue yet. There's our revenue to this point. Note too that this is just showing the revenue for the second month. So if you're comparing that to the 2-month period, as we might do in some of the QuickBooks examples, then that's why it's going to be different. It's only for 1 month rather than the January and February. This is just February. So we're going to scroll down. We have $54 of net income still. That 54 part of the calculation of ending owner's equity on the statement of owner's equity to get to ending equity of $144,229. That $144,229 also found on the balance sheet here. And that is, of course, keeping us in balance there.